Yeah, you got it? Okay.
Yeah.
And you can see my screen? My screen's visible? It's visible. Okay, good. Excellent. That's what we need. Okay. There's a question in the chat about the how do you want the regression compared to the S&P 500 for each company? So the regression analysis is it's going to fit a line through the equation y equals xb, where y is the return on the individual stock and x is the return on the market as a whole. So if you implement that regression in Excel according to the procedure that we did on Friday of last week, and that's in the tutorial notes, if you implement that regression, the intercept term on that best fit line is going to be equal to 0. And then the slope term is going to be what the beta is. That's the beta between the stock you're estimating and the S&P 500 as a whole. So that slope term is the beta in the capital asset pricing model that we've been evaluating. Is that what you're asking? Yeah, exactly. So there's 4 different betas. You have 4 stocks, you have 4 assets. So the question is, do you repeat the calculation 4 times for each individual stock? The answer is yes. You want to calculate the individual beta for each of the 4 individual stocks, and that beta is measured relative to the S&P 500. So for each model, if you have the capital asset pricing model equation that was drawn here. So you do the estimation with for one stock, the returns to ExxonMobil minus the risk-free rate, and you have that be your Y variable, and you have this market premium be the X variable, and you estimate that regression, so you get a beta for ExxonMobil. Then you do that separately again for Exelon. You have Exelon returns on the left-hand side, and then you have market returns on the right-hand side. Implement that regression, that gives you a beta for Exelon, and then you do that again for solar, First Solar. So it's 4 separate. So the X value, and the question in the chat, the X value is the market minus the risk-free rate. The Y value is the individual stock minus the risk-free rate. So it follows this, it just follows this sort of structure. Y equals beta X. X is the stuff on the left-hand side. Y is the stuff on the right-hand side. Sorry, X is the stuff on the right-hand side. Y is the stuff on the left-hand side. Okay. This slide is where we left off. This slide is where we left off on Monday. This is the answer to the question of what's the correct discount rate to use for a particular firm's project. We had assumed a discount rate in the past. We had looked at cash flows and then discounted them back to the present, just based on an assumed discount rate. But this part of the course is going to actually start to look at where that discount rate comes from. Overall, it's going to be composed of 2 terms that represent the different sources of financing for the firm. One source of financing is equity, which is owners of the firm's own money. Either it's new stocks that are issued or it's earnings that are retained and recycled back into the firm. That's equity. Debt would be the firm actually goes onto bond markets and borrows to try to get financing for its projects. So those are the 2 sources of funds. That corresponds exactly to the balance sheet model of the firm, where we have on the left-hand side of the balance sheet, we have assets. The right-hand side, we have liabilities. The liabilities represent the sources of funds. The liabilities represent debt. obligations, and then equity, which is the residual amount of ownership in the firm. So those two aspects, those two features of the right-hand side of the balance sheet are represented here in this weighted average cost of capital equation, where I'm going to use the variable S to denote the amount of equity that the firm has. That would be the amount of equity that's either in the firm as a whole, or maybe the amount of equity that will be put forth for a particular project, so that you could think of this as either applying to the firm as a whole or to a particular project. But the firm overall can be composed of some equity and some debt, and individual projects can be financed with some equity and some debt. In either case, the required return, or the discount rate, or the cost of capital, that's going to be determined by the amount of financing that's allocated in equity versus debt. So S is the fraction of the capital that is equity, and then B is the fraction, S is going to be the total dollar amount of equity, the total dollar amount of equity that's being used to finance a project or a firm. B is the total dollar amount of debt that's being used to finance a project or a firm. And so overall, a firm's total value is its combination of debt and equity. Debt and equity together, if you add them together, those equal assets. So that's the total value of the assets of the firm. So we can represent, we can use this fraction S over S plus B to represent the fraction of the financing of the firm or a project that is equity financed. We can use the fraction B over S plus B to denote the fraction of financing that's coming from borrowing money. And then those are the weights. So that's where the weighted average cost of capital, those weights are the fraction of the financing taken up by those two different sources of finance, the equity versus debt. And then each of those types of financing is going to have a particular required return. In the case of debt, the required return that debt holders are going to be asking for is just simply the interest rate that they charged you when you first took out the loan, or it's the interest rate that they would charge you if you would start taking out a loan. That gets multiplied by 1 minus the tax rate. Well, I'll get to that in a second, just to explain exactly why that 1 minus the tax rate term is multiplied on the right-hand side there. So bondholders are just going to require whatever interest rate you agree on when you take out the loan to begin with. But equity holders, their required return is a little bit more complicated because it's an opportunity cost measure. It represents the cost of equity is going to represent what investors are going to require of you if you are going to recycle your cash flow back into the firm rather than paying out dividends. So the fact that it's an opportunity cost, the investors always have the option to take their money out of the firm and put it in just a balanced market portfolio. And if they believe that your returns on your firm, or your returns to your project, are not going to yield as much as the market as a whole, adjusted for risk, then they would prefer to have the cash and invest it in just an indexed market portfolio. If they believe that your firm is able to generate returns above and beyond the market, then they would be okay with you recycling your money, recycling your excess cash back into the firm rather than paying out dividends. So that's the sense in which this RS is the required return. It's what investors expect. It's what, at a minimum, that investors expect, given that they could always take their money out of your firm and put it in a market portfolio as a whole and earn some rate of return with some amount of risk. So those are the components of the weighted average cost of capital. I want to just remind everybody, question in the chat. So I posted the notes on Canvas, so that's already there. Whatever I cover today will also be posted on Canvas. So this is the basic result of the capital asset pricing model. This stuff on the right hand side is the capital asset pricing model. The return on an individual stock is equal to the risk-free rate of return plus beta times the market premium. That market premium that's represented here in this equation. That market premium is also represented by the the vertical distance between the market rate of return and the risk-free rate of return. So we have the market premium. That's the RM minus RF. That gets multiplied by beta. That gets added to the risk-free rate to determine what the expected return on a particular asset is. So this is just the results of the capital asset pricing model. A particular asset is going to require, or investors are going to require a certain rate of return on your company as a result of how much risk is involved. If your company's returns are very volatile relative to the market portfolio, then they're going to require a higher expected return in order to tolerate some of that volatility. If your returns are not as volatile as the market as a whole, then they're not going to expect as much of a return because your returns are a little bit safer than the market as a whole. And this beta is the parameter that represents the degree to which a particular asset's returns move together along with the market portfolio or against the market portfolio. So the market portfolio itself has a beta of 1 because it, by definition, as the market moves up and down, obviously the market as a whole moves up and down by definition by the same amount. Those are just the same, those are exactly the same variables, so they move in the same direction and in the same proportion. But particular assets might move together with the market in kind of a scaled down way or maybe a scaled up way. So on this current graph, we have RS, which just represents the returns on a particular stock. I'm just going to pretend that this stock has a beta of 0.5. So it moves with the market, but sort of in a scaled down fashion. So it'll move when the market's up, it's going to sort of move up, but about half as much. And when the market's down, it's going to move down, but about half as much. So it's going to have a less volatility than the market as a whole. And so investors, by this relationship, by this CAPM relationship, investors are not going to require as high of a return on that asset because it's relatively safer. It's safer than the market as a whole. So investors are willing to tolerate a little bit less return on that asset because it has a degree of safety relative to the market portfolio. That's an example of the capital asset pricing model and the predictions of the capital asset pricing model for an asset whose beta is less than 1. But we could also have the case where the beta is in excess of 1. So this would be, in this case, we have another asset that has a beta of 1.5. Beta is 1.5. Because beta on this stock is 1.5, it's overall a little bit riskier than the market as a whole. And so investors, in order to tolerate that amount of risk, they're going to be expecting a rate of return above and beyond RM, which is the market average rate of return. It's going to be expecting a rate of return above and beyond that, according to this security market line. So we remember this is either called the security market line, or we've also called it the capital market line. So that's the line that defines the expected return given a particular asset's risk level. So that's one of the components in the WACC. So we have RS, which is the return on equity for the firm. That's coming out of this CAPM equation. It's given a firm's beta RS comes out of that capital asset pricing model equation. Plug in beta, plug in the risk-free rate. You know the market average returns, you know the risk-free rate. And so you use all those variables to figure out what the expected return or the required return on asset S is. So that's the first component. The second component is the return on debt. That's just the yield to maturity of a firm's debt. That yield to maturity just represents, in effect, the interest rate that the firm is paying on its debt. And so that's the bondholders only are going to require the rate of return that you've agreed upon when you've made your initial borrowing, when you've taken that initial action of borrowing that money. So that RB is that's not as complicated of a calculation, because it's simply the yield to maturity on the bonds. It doesn't have to rely on any capital asset pricing model relationship. It's not related to the opportunity cost of capital. So that's just simply the interest rate on debt, or the yield to maturity. And then we have this tax rate term, which is adjusted by the cost of debt. So if we remember that if we remember that interest payments are tax deductible, so interest, we have we have revenues, we have costs, we have revenues, subtract off costs, we subtract off depreciation. That gives us EBIT, earnings before interest and taxes. The next thing that gets subtracted off is interest. And that's taken out before taxes are assessed. So any debt that the firm has on its books where it's paying interest at regular intervals, that's going to act as a tax shield. And so this term here represents the tax savings that results from having debt on the books, or having a fraction of the financing of a particular project be financed with debt. And so then part of those expenses are actually tax deductible. Some of those interest payments are tax deductible. And so you pay the interest, but in return, you sort of save some money on taxes. And we've seen that before. We saw that in the unit on bond valuation. So this is just this is actually the bond problem that I had on exam 2. We can just think about what happens when a firm has a certain amount of borrowing. So they borrow at 8%. I can't remember exactly how much I can't remember what the size of this loan is, but the amount of borrowing that took place was at a rate of 8%. So 8% was the required rate of return on that debt. We looked at on the exam. We had 2 scenarios. One in which the firm financed its activities with borrowing, with a bond, and we looked at the case where it financed its activities without a bond. And with the bond, it's got interest payments it has to make to its bondholders. So those are at 8%. Again, I don't remember the exact figure of the borrowing amount, but it's some amount of borrowing, which at 8% results in $31,500 of interest that's due every year. Whereas without the bond, you have no interest payments. So that's going to affect your pre-tax income, because you subtract the interest from that EBIT, and so your pre-tax income in each of these cases is it's 383,500 in the case that you have a bond. It's identical to your EBIT in the case that you don't have a bond. It's 415,000. And then if taxes are assessed on this pre-tax income, the tax amount, if we assume a tax rate of 35%, taxes are going to be 134,225 for the case with the bond. They're going to be 145,250 in the case without the bond. And so there's some net income associated with that. But if we take these tax savings amounts, so this is try to remember this 134,225. We had 145,250. All right, so then the taxes saved ended up being 11,025. Now we had interest payments was 31,500. 31,500 was our interest payments. So if we think about our interest payments minus our tax savings, the effective interest then we're paying, or the interest net of our tax savings, is 20,475. And if we think about that as a fraction of the interest, so 20,475. If we consider what that is as a fraction of the interest payments, so the interest payments were this 31,500. That ratio is actually 0.65, which turns out to be 1 minus the tax rate. The tax rate was 35%. The effective interest payments relative to the actual interest payments was 0.65, right? So this is essentially, just with that simple example, we showed that this is equal to 1 minus the tax rate. So that's what, that 0.65, if we just multiply that 0.65 times the interest rate, this example shows that that's the correct procedure to go forward with when you have tax deductibility of interest. So that's why this term, this 1 minus the tax rate, that's the 0.65 that we just saw. When you multiply that 0.65 times what the nominal borrowing rate was, which was 0.08. So that's a more complete explanation of where that comes from. That 1 minus the tax rate term comes from. Okay. So that's, are there any questions about that? That's kind of a little bit of some review that from the section on bonds, but that's where this that's where some of this material actually comes back and becomes relevant for later sorts of calculations. So I'm just going to go through a couple examples here of how to calculate WACC. So just to apply exactly what we've been doing. We're going to look at an example of a firm where the return on equity is 10%. So that's the RS that we were talking about. RS would be 10% or 0.1. The yield on the debt is 5%. So that's that would be RB. That's just the current borrowing rate. We have a case where half the firm's financing activities are equity, and the other half use debt. And so in that case, the the S over S plus B and B over S plus B those would both be equal to 0.5. And then the tax rate is 35%. So if we're doing this WACC calculation, we would just take the S over S plus B. That's the 0.5. So we use this number goes right there. That gets multiplied by RS, which is 10%. So that would be this number going right there, plus the remaining share of the company's financing, which would be debt, which is the remaining half. The cost of debt is 5%, and then the tax rate is 35%. So this would be 0.65, because you take one minus the tax rate is what goes right there, and we have TC equal to 0.35. So if you work that out, you get 6.6. You get 6.625%. Right. So that's what was on the slide, but that's the way that you do that calculation. We could do another example. Just in this case, the return on equity and debt are identical, but in this case, we're not given the actual percentages of the company that are financed with equity or debt. We're not given the dollar amounts that are financed with equity and debt. Instead, what we're given is the debt to equity ratio, which is 2 to 1 in this case. So there's 2 parts debt for every 1 part equity. So in this case, the WACC is going to be actually, remember, it's the share of the firm that's financed with equity. If the debt to equity ratio is 2 to 1, that means there's 2 parts debt to 1 part equity. So 1/3, in that case, 1/3 of the company is equity financed. You'd multiply that by the required return on equity. You'd add that to the share of the company that's taken up by debt times the cost of debt. So in that case, debt to equity ratio is 2 to 1. So 2 parts. There's 2 parts debt for every 1 part equity. There's 3 parts altogether. So 2/3 would be the fraction that's debt financed. Let me actually just, this number would be 10%. Add that to the 2/3 times the cost of debt, which is 5%. And you have a 35% tax rate. And so you would multiply that right-hand term by 1 minus the tax rate. That's the 0.65 number that we calculated before. Again, you can think of that as the adjustment factor that scales down the amount of interest you're paying to take account for how much taxes you're saving in the process of having to pay that interest. That's the example that we had worked out before. So once we have all these terms calculated, we end up with a 5.5% weighted average cost of capital. Right. So that's the mechanics of that. Those are the different components of that. There's another. I'll just pause for a second to see if there's any questions about that. Okay, so I want to make some comments on this relationship between beta and leverage. So beta represents the degree to which the returns on some company move together with the market, either in a scaled up fashion or a scaled down fashion. But there's actually, there's a certain, there's particular factors that can influence how large a beta is. One of them is both of them have to do with leverage, but one of them is operating leverage. The other is financial leverage. Both of them are actually just variations on the same concept. Operating leverage is a case where you have a high amount of fixed cost associated with your production and low variable cost, right? So you sink a lot of money into a project to begin with, and then once you've sunk that money, every individual sale you make is very cheap, and so you can make high margins on everything after that. Once you once you sell a certain amount, then you can sell enough to cover those fixed costs, and it makes sense. So you actually, by having high fixed costs, you actually subject yourself to more volatility. If more of your money is sunk in a particular investment, if you have a lot of your expenses just be fixed and not depending on how much you sell, that actually exposes you to a little bit more risk, because if you have a high fixed cost, you're able to produce a lot very cheaply. And so if you can make a lot of sales, you can make a solid margin on everything you sell, and you can have really high revenues, and that can cover your fixed costs. But if you don't sell a lot, even if you can produce very cheaply, maybe you don't sell enough in order to cover your fixed cost. And so if in the event that sales are high, you make a killing because you're able to produce each unit very cheaply. In the event that sales are low, you make a good margin on every unit you sell, but you have all these fixed cost obligations, which you've either already paid or maybe you're paying them out through debt service. Those are fixed. Those don't depend on how much you sell. Those are expected of you to pay those back regardless of how much you sell. And so when sales are low, you have high fixed obligations and you have low revenues. And so the overall money you make in the event that sales are low is very small. Contrast that to a situation where maybe you have very little fixed costs, but you have high variable cost. So you can adjust very easily. If sales are high, you can sell a lot, but it's very costly for you to sell those products because you haven't invested in the efficient fixed capital in order to produce those things very cheaply. So you have a high variable cost, and so you make a small markup on everything you sell. And so revenues, even if sales are high, revenues are not as high as they would be if you had made that high fixed investment to begin with. But on the other hand, if you have high variable costs and low fixed costs, you don't have, you're not tied down to having to pay your fixed cost in the event that sales are low. When sales are low, you can just sell less of your product, and you don't have as much of a fixed cost obligation. And so you don't have the potential to lose as much money in the event that sales are low. The same amount, or the same principle is operating here in terms of financial leverage, where the amount of debt that you have is going to affect your fixed obligations. That debt, those bonds that you've issued, which have fixed regular payments, you have to pay those regardless of how your company's actually doing. Whereas the equity is the residual. The equity, the equity holders get to keep everything that's left over when times are good, but they don't. If times are bad, they don't get. They're the last people to be paid. bondholders are always the first people to be paid. So that's the sense in which beta affects leverage. So we can think about this total the total. We can think about a firm as a portfolio of some combination of debt and equity. So the firm, the beta on the whole portfolio, that's the degree to which returns on overall assets to the firm, the degree to which those assets return something that's comparable to the market, or maybe above and beyond the market with some more risk associated with it, or maybe below the market but with a little more with less volatility associated with it. That's the beta on the overall assets. But you can actually change the equity beta. We can distinguish between the equity beta and the debt beta. And you can actually change the equity beta by levering yourself up, by going into bond markets and actually borrowing more money. And you can increase your returns to equity by borrowing. I have just a simple example. I want to try to explain this with just a simple example of how levering yourself up financially can increase your returns, but also increase your volatility. So let's say you take $1,000 to the blackjack table. Right, so you're pretty good at blackjack, and you can actually convert. If you go play blackjack, on average you're gonna be, let's say you're really good at it. You can count cards or something like that. You can get $1,300 half the time, and maybe you'll get only $900. You'll walk away with $900 the other half of the time. So on average, you're sort of coming away with. On average, you're coming away with $1,100, and so that's your average or your expected winnings. And if we think about that as a percentage of how much capital you invested in that blackjack project, that's going to be 1.1 return. So that's about a 10% return. That's scenario one. This is no leverage. Now let's say that you take, let's duplicate this. Now let's say that you take $1,000 to the blackjack table. So in the first case, we have no leverage, and we have some variance in returns, but we have some expected return. Let's say we take $1,000 now, but we're going to borrow 500. So 500 of this is our own money, and 500 of this is borrowed money. We're going to borrow at, let's say, a 5% rate. Now, let's say we have the same skills. We have the same underlying blackjack skills. We're still able to count cards, and we're still able to come away with some winnings. After, on average, we're going to come away ahead if we play enough times. We win more than we lose. But this $500 at 5%. That's gonna, there's gonna be interest payments. You have to pay back the 500 that you borrowed, and then the interest payments on that is gonna be $25. So the capital that you walk away with as the owner, so you have $500 of your own money, $500 of borrowed money. So that 525 of these winnings have to be paid back to the people that lent you money to play blackjack. So you have to subtract 525 from each of these numbers. So in the event that you come away with 1,300, your net winnings after you've paid off your bondholders, this is the residual. You can think of this as like the returns to equity. You have 775 of return to equity in the event that you win. You only have 375 return to equity in the event that you lose. But if you think about this relative to the capital that you invested, in this case, you had 775. If we divide that by the $500 worth of capital you invested, that's going to be equal to 1.55. 1.55. That's actually a 55% return. And if you consider that for the scenario where you lose, you divide the 375 by the $500 of capital, that's a value of 0.75. So that's actually a negative, that's negative 25%. So those are the possible returns in this leverage scenario, either negative 25% or 55%. Which on average, if say that each of these scenarios is equally likely, on average, this is a return of 15%, which is higher, 15% return, that's higher than the 10% return that we had when we were just using our own money. So we can lever up, we can borrow a bunch of money, we can actually increase our expected returns, but we're going to be increasing our variance, right? So in some scenarios we make 55% return, in other scenarios we lose 25%. The equivalent values in the other case, this was a 30% gain in the upside, and a 10% loss in the downside. So we've actually, if you compare these, we get, by levering up, by borrowing, we have a 10% return on average. This is no leverage. And this is leverage. By borrowing, we can increase our expected returns. That's like increasing the returns to equity. But we increase our exposure to risk. We make ourselves more vulnerable to risk. We have a higher upside, but we also have much lower downside compared to the case where we don't borrow, where our upside is only 30%, but our downside is only 10%. That's an example of how the beta is actually affected by the amount of leverage that the firm takes on. And so that's the reason that that this equity beta, the returns to equity, or the degree to which the returns on equity move together with the market or against the market in a scaled up or scaled down fashion, that actually depends on the amount of leverage. That depends critically on the amount of leverage that this firm is taking on. And you can think about that and it's kind of a difficult thing to intuit at first, but I think this blackjack example, where your mean returns actually increase, but your variance also increases as you take on more leverage. That's sort of the principle that's behind this this idea that you can affect your equity beta by taking on more debt. So are there any questions about that scenario I just painted out? We'll go over some more of this this relationship between leverage and beta later on. We'll cover that a little bit more. But does the intuition of that example make any sense? Right. Okay. Yeah. This is here's the one with yeah, you can think about the beta of the portfolio. That's like the beta when you're using all of your own capital. and that's composed of these two parts. And so if there's no debt, then the equity beta is just equal to the portfolio beta, because your portfolio is all equity in the event that you have no borrowing. So your portfolio beta is just by definition the same as your equity beta, because all of your own money is being used for the project. But you can adjust your own expected winnings by levering up. You can borrow money. That's going to increase your expected return. You'll be able to make a killing when times are good. You'll lose more when times are bad, but on average, you can actually increase your overall winnings. But doing so is going to expose you to more risk. But the money that you come away with is more, because the money that you're obligated to pay back to debt holders doesn't depend on your winnings. It doesn't depend on your blackjack winnings. It only depends on the interest rate that you agreed on at the start of the game when you first borrowed the money. So we'll do some more manipulations, and we'll kind of discuss this this fundamental relationship here a little bit more later. But that's the intuition for this. I would recommend coming back to that blackjack example, just to see how the beta can be affected, or the variance of your own equity, the variance of your returns to equity can be affected by how much you're borrowing in the process of undergoing your activities. In this case, it was blackjack, but you can think of it just like a firm acquiring assets and then trying to sell products into the market that it thinks people want to buy. Okay, question in the chat. In the leverage example, are you borrowing 500 and using 500 of your own money, totaling to 1,000? Then you have to pay the debt 525. So you started with 500 and ended with 375 of your own money. Yes, yeah. And in the low case, you put down 500 of your own money and you walk away with 375. That's a $125 loss. In the case that you don't borrow, you only have a $100 loss, because you're putting down 1,000 of your own money. You're coming away from the table with 900, so that's only a $100 loss. So your losses, your overall losses actually increase when you lever yourself up, because you have these fixed debt obligations to your creditors. You have to pay your creditors back before you take your own money home. So yes, the way that you've described this is exactly right. You borrow 500, you use 500 of your own money, you use that $1,000 together, which is partly financed by debt, partly financed by your own money. You take that to the table, you play blackjack, you come away with your winnings, and then the first thing you do is you pay back your bondholders, the people that lent you the money. You pay them back, and then you get to keep whatever is left over.